Hello everyone. Today we're going to be talking about the statement of cash flows. This is the fourth of the main financial statements that companies prepare at the end of each period when they report their information to the users of that information. What essentially is the statement of cash flows? Well, it explains to these users why the company's cash balance either increased or decreased over the period of time, and namely, what was the reason that cash came in or cash went out. What are we spending our money on? How are we bringing money in? So this statement will report the cash flow of the business. It'll report, in essence, what the sources of income were, source of cash inflow was, and the sources of cash outflow were. And I keep saying over a period of time because just like the income statement, the statement of cash flows tracks a change over a period of time. So you could have a statement of cash flows for the last month, the last quarter, or the last year. How is this going to help users of our information? Well, firstly, it's going to help them predict future cash flows. If a company is cash light, it's in serious danger of having to halt operations. And even more so, if it's cash light, they won't have the free cash on hand to pay their owners dividends. And owners aren't going to be happy if they don't get money. So the statement of cash flows basically answers the question for a person: is this company going to have the proper fundage available to meet its operating expenses and have some left over to pay me my share? And that is what all companies really want to do. They want to have enough money to meet, all of their necessary needs for the period and keep their owners happy. So in essence, the statement of cash flows also helps people evaluate the company's management, make sure that they are being effective with their cash. They're turning every single dollar they have into as much profit as they possibly can. So a user of this information can look at a statement of cash flows and again answer the same questions that we just talked about. What are we spending cash on? Is this cash being spent wisely? And is there enough cash on hand to make this company a safe and stable investment? On a statement of cash flows, you're going to need to break down your activities into three main groups that go in the body of the statement of cash flows. They are the operating activity section, the investing activity section, and the financing activity section. What goes into operating activities are the standard activities of the business that would cause its cash flows to change. So firstly, generating income is a big part of the statement of cash flows. That's how much money you are bringing in the first place. Paying your everyday operating expenses. Collecting on payables, or receivables, which were owed to you, and paying off the payables which you owed to somebody else. The items that go into the investing section are the items that a company would purchase when they invest in the long-term success of that business. Well, what would that be? Well, if a company wants to expand, they're going to need more facilities, so buildings. If they want to build their own buildings, they're going to need a plot of land to build it on. Land would go there. They need stuff to put inside that building, which helps them produce the products that they are known for. So equipment would be upgrading your equipment would be investing in the long-term success of your business. All of those items go into investing activities, and they all require money, which a lot of companies will raise from outside sources besides their normal internally generated profits. Which leads us to the third section, financing activities. These are the cash inflows and outflows related to any long-term debt your company could take on, signing a mortgage, signing a notes payable, issuing bonds to bondholders, and equity as well, issuing shares of either common or preferred stock to the public, or even buying back your own common stock and holding it in treasury, hoping to finance more of your activities by that profit you make off the resale of that treasury stock. And another item that's going to go into the financing activity section is always going to be dividends, because dividends are, in essence, an extension of your stock. They're a necessary cost of issuing ownership to people. Well, if you're their owners now, you have to pay them a portion of the proceeds. So dividends also count as a financing activity. We are going to be using a method for this called the indirect method. And in the indirect method, it's pretty easy to tell what item goes into which section by where you would put it on a classified balance sheet. So if an item is a current asset or a current liability, your accounts receivable, your accounts payable, your inventory, your salaries payable, all of those items are part of your everyday operations, and they would all end up in your operating activities. If it goes in the investing activity section, that is all of your long-term assets, namely your plant, property, and equipment. But there are definitely other things that could go in here. Buying a copyright or a patent from another company would also be something where you would invest in the long-term success of your business. If you have a patent, you're the only company that can make that particular product, and you're the only company that can do so for an extended period of time, so it is a long-term asset. It would go into your investing activities. And then financing activities, again, deal with all of your long-term debt or your equity. So your mortgages, your bonds, your stocks, they would all go into financing activities. So if you ever, stumble on where to put an item into your statement of cash flows, your best thing to do is think, where would I put this on my classified balance sheet? What would I classify this at? And then this is the guide to what section that item has to be reported in. There are activities that happen during a period which will never affect your cash account. Something like exchanging shares of stock for a long-term asset. If you want to acquire a production facility from another company and you don't want to have to pay them all of that cash at the time that you acquire it, maybe they would be willing to sell it to you in exchange for shares of your common stock. Well, in that particular journal entry, there's no cash changing hands. You are exchanging stock for a building. But those accounts are going to increase in value greatly on your balance sheet, which is going to make users of your information wonder, well, why did this go up so much? And I'm not seeing how you paid for it in the statement of cash flows. So as a supplement to the statement of cash flows, in the notes at the bottom of it, you should disclose any significant non-cash activities that you had during the period. Yes, it's not directly explaining why cash came in and why cash came out, but it answers the question that people are looking for. How, are you monitoring your cash flow? How are you financing your activities? And another example would be to take out a long-term loan to finance a piece of equipment. So non-cash activities will show up on the statement of cash flows, which is kind of an oxymoron. But it's there for the convenience of our users, because if our users are looking at our balance sheet and they see a huge jump in, say, common stock, they're by nature going to expect a large jump in the amount of cash that we receive. But if we're issuing that stock for something besides cash, if we're bartering and trading it for another asset, that would not, show up on the normal body of the statement of cash flows, and then it's going to make them wonder. So we answer the question for them and disclose at the bottom of our statement of cash flows, these were our significant non-cash activities for the period, and that will help explain why there's huge changes on the balance sheet which are not showing up in the statement of cash flows. So some specific activities, as I've mentioned some of these before, but we'll run down through. What would be an inflow, something that would increase your cash? That would be an example of an operating activity, and it would be the sale of merchandise, inventory, or services to your customers for which you were paid in cash. If you had any investments that you were in, could be interest revenue, could be dividend income, that would increase your cash flow. Those would both be cash inflows that get reported under the operating activity section. What would be an outflow of cash that would happen, that would be typical of your normal operations? Purchasing merchandise, inventory, paying your everyday operating expenses, your rent, your utilities, etc. And also financing things like paying the interest expense on loans, or unfortunately for all of us, having to pay Uncle Sam his share of your profitability in the form of income taxes. For investing activities, this section only deals with long-term assets, so the sale of property, plant, equipment, or investments would increase your cash flows in your investing section, because you are the one selling it, therefore you are the one getting the cash. And if you issue a notes receivable to another institution, you let them borrow money and they pay you back in the end, that would be a cash inflow when you got that repayment. Cash outflows, typical to your non-current assets that would show up in the investing activity section, are the payment to purchase property, plant, equipment, or investments, and also to repay any outstanding loans you would have to a bank or a mortgage broker. And then for financing activities, which deals with long-term debt and equity, you would have the issuance of stock, the sale of treasury stock. Those would be cash inflows, because you would be selling that ownership in exchange for cash. And for long-term debt, anytime that you borrow money, you sign a note with another institution, you're receiving the cash at the time. That would also be a cash inflow for financing activities. Outflows would be all of the payments that you had to make for this, so the payment of dividends, the payment to reacquire treasury stock, or the payment to service the debt on your loans. And if an item does not have cash involved in it, but it is a significant in nature where it's going to make people wonder how do they finance that activity, you put it in the bottom of the statement as a non-cash investing and financing activity. So some quick events right here to determine what type it would go in or what section of the statement of cash flows it should appear in. ABC Company takes out a short-term bank loan. Short-term is the operative word here, which means this loan is for less than a year. And if it's for less than a year, it is a current liability, and current liabilities on a statement of cash flows go in the operating section. ABC Company pays $4,000 in cash dividends. Well, that is a withdrawal account, and the reason we are withdrawing money from the business is to give it to our owners who have equity in our business, and equity goes in the financing section. If we purchase additional inventory in cash, assuming we're a retailer, that's a normal course of operations for us. It's also a current asset. We expect to sell that inventory that we are purchasing within the next year, and since it's a current asset, it's going to go in the operating section. If we made the cash purchase of a building, that's an asset. That's something that we are going to use to increase our profitability in the future, but we're going to do so with that particular asset for more than a year's time, which means since it's non-current, it has to go in the investing section. If ABC Company issued $150,000 worth of common stock and received cash, that's a piece of financing. That's how we bring funds into the business. It's an equity account, and all equity accounts affect the financing section of the statement of cash flows. If ABC Company sold a piece of equipment for $50,000, well, that piece of equipment is a non-current asset. It would go into PP&E. And just like we had with the building above, all non-current assets get reported in the investing section. And then lastly, if ABC Company converted $100,000 worth of long-term bonds into common stock, what section would this appear in? Well, long-term bonds and long-term debt would show up typically in the financing section. Common stock is an equity account, and equity accounts also show up in the financing section. But since both of these things involve financing, we would put this in the financing section, right? Not so fast. And the reason being, no cash is actually changing hands in this transaction. We are just getting out of this long-term debt payment we had for our bonds by converting it to another item. But we're not paying out any cash in this case, and since those bonds were already out there, it's not like we're issuing, raising any money by the sale of the stock. We're just, basically retiring a debt with stock. There's no cash coming in. There's no cash involved at all in this transaction. It is therefore a non-cash activity and will be reported in the non-cash investing and financing activity section of your statement of cash flows.